What does it take to start building serious financial security? Not a six-figure income, not perfect market timing. In fact, it's something as simple as $100 a week. That might sound small, about the cost of a dinner out, a few subscriptions, or a new pair of sneakers, but over time, this habit can lead to big results. Imagine this: $100 invested every week for 10 years could grow to nearly $90,000. Most people overestimate what they can achieve in a month, but underestimate what's possible in a decade. In this video, we'll break down the biggest myths about investing, reveal how market crashes can actually work in your favor, show the power of starting early, and share practical tips for making investing a habit that sticks. Think you need thousands to start investing? Think again. The truth might surprise you. There's a persistent myth that keeps countless people from ever getting started. The belief that you need a huge sum of money before investing makes sense. For many, this idea is enough to keep them on the sidelines. The world of investing can look intimidating from the outside. Images of professionals trading large amounts, or stories of people waiting for a windfall before they even consider putting money into the market. But the reality is much simpler. You don't have to wait for a big payday or some perfect amount. You can start with what you have, even if it's just $100 a week. Hesitation is normal, especially when you hear advice like, just start with $100 per week. It's easy to wonder if that's really enough to make a difference. Many people put off investing, telling themselves they'll wait until they get a bonus, or until the market feels safer, or until their expenses go down. But here's the thing. Waiting for the right time often means missing out on the most powerful force in investing: time itself. Every year spent waiting is a year your money isn't working for you. Let's look at what actually happens when you commit to steady, small contributions. Imagine you started putting away $100 every week starting in 2015. Fast forward to the end of 2024 and you've invested a total of $52,000. That's the amount you've put in, but what's more important is what it's grown into. With steady investing and the help of compounding, that $52,000 could have grown to about $90,000. That's not a theoretical projection. That's what consistent investing over the last decade could have achieved, even through all the market's ups and downs. Suddenly, $100 a week doesn't seem insignificant at all. This approach isn't just about the numbers. It's about the habit you build along the way. Consistency is the real driver here. By sticking to a routine, you're not only growing your portfolio, but you're also building the discipline that separates successful investors from those who never quite get started. The best part? You don't have to worry about picking the right time to buy. That's where dollar cost averaging comes in. Dollar cost averaging means investing the same amount regularly so you buy more when prices dip and less when they rise, taking market timing out of the equation. Some people worry about what happens when the market drops. The instinct is to pull back or pause investments during downturns, thinking it's safer to wait until things recover. But the truth is, those dips are actually opportunities. When prices fall, your regular $100 buys more shares, setting you up for greater growth when the market rebounds. History shows that sticking to your plan, even when the headlines are scary, pays off in the long run. So, by sticking with $100 a week, even through dips, what would your account look like after 10 years? Market downturns are often painted as disasters, but they can actually be one of the best things that happen to a steady investor. When the news is full of warnings and your portfolio drops in value, it's natural to feel uneasy. Most people want to pull their money out and wait for things to feel safe again. But the reality is, those moments of uncertainty are where opportunities for building wealth often hide. Think about it this way. When prices fall, you're essentially shopping in the investment world's clearance section. If you've had your eye on a pair of sneakers and suddenly they're 30% off, you wouldn't hesitate to buy them. The shoes haven't changed, only the price has. The same idea applies to stocks during a downturn. The underlying companies are still there, but now you can buy more shares for the same amount of money. That's a deal that works in your favor over time. This isn't just a theory, it's backed by real data. During the market corrections in 2018 and 2022, investors who kept putting in $100 a week didn't just weather the storm, they came out ahead. In our 2015 to 2024 example, that consistency turned $52,000 into about $90,000, despite those crashes along the way. The reason is simple. When the market dipped, each dollar bought more shares, and as the market recovered, those extra shares grew in value. As we saw earlier, consistent investing shines when markets dip. You don't have to guess when the market will hit bottom. By sticking to your schedule, you automatically buy more when prices are low and less when they're high. This approach removes the pressure to time the market, which is something even professionals struggle to do. It's normal to feel anxious when you see your investments drop in value. The instinct to sell is strong, but history shows that those who stay the course are rewarded. Selling during a downturn locks in losses and means missing out when the market rebounds. The S&P 500's track record from 2015 to 2024 proves it. Despite two major corrections and plenty of volatility, the overall trend was up. Investors who kept investing regularly, ignoring the noise, saw their portfolios grow far beyond what they put in. Let's look at the numbers again. If you invested $100 every week from 2015 to the end of 2024, you would have contributed $52,000. But because you stayed consistent, especially during the downturns, your portfolio could have grown to about $90,000. Those tough years didn't derail your progress, they actually helped. Every time the market dropped, your steady contributions picked up more shares at lower prices. When the market bounced back, those shares worked even harder for you. The key is to reframe how you see market drops. Instead of viewing them as threats, see them as rare chances to accelerate your wealth building. It takes discipline to keep investing when everyone else is pulling back, but that's exactly what sets successful investors apart. By continuing to invest during downturns, you're quietly setting yourself up for greater gains in the future. Feeling reassured or still worried about downturns? Next, we'll see how starting earlier magnifies these gains. When it comes to building wealth, patience and timing matter far more than most people realize. The real advantage isn't just about how much you invest, but how early you start and how consistently you stick with it. This is the power of patience. Starting sooner gives your money more time to grow, and over years, that difference becomes dramatic. Let's break it down with a simple example. Imagine two people. One starts investing $100 every week at age 25, and the other waits until 35 to begin. Both stick with the plan, putting in $5,200 a year, but the first has 20 years to invest, while the second only has 10 years by the time they reach 45. With an 8% average annual return, the early starter ends up with about $247,000 after 2 decades. The second, who waited, ends up with around $75,000. Both invested the same amount, but the person who started earlier finishes with nearly 4 times as much. That gap isn't magic, it's pure compounding over time. Why does this happen? It comes down to compounding. Starting early allows your returns to generate even more returns. In the beginning, growth feels slow, but over time, your earnings start building on themselves. It's like planting a tree. At first, progress is barely visible, but after a few years, the growth accelerates as the roots deepen and branches multiply. Investing works the same way. The longer you give your money to work, the more exponential the results become. This is why time is your most valuable asset as an investor. If you start early, you don't need to contribute as much each week to reach your goals. Waiting means you have to play catch-up. investing much more just to get close to what an early start could have achieved. Consistency matters, but the earlier you begin, the more you benefit from every dollar you put in. But what if you're not 25 anymore? Maybe you're in your 30s, 40s, or beyond, and you worry you've missed your chance. The good news is, it's never too late to start. Even beginning with smaller amounts, like $25 or $50 a week, can make a meaningful difference over time. For example, $50 a week invested for 15 years at an 8% return can still grow to about $65,000. The key isn't the amount you start with, but building the habit of investing regularly. Once you begin, compounding does the heavy lifting for you. It's easy to put off investing, thinking you'll start when you have more to contribute or when life feels less busy. But time will pass whether you invest or not. 10 years from now, would you rather look back and see a portfolio that's been quietly growing or wish you'd started sooner? Most successful investors don't obsess over perfect timing or regret missed opportunities. They focus on staying consistent no matter what. Accessibility is another important piece of this puzzle. Many people hesitate to invest because they think small contributions won't matter. In reality, starting with manageable amounts makes it easier to stick with the habit. Automating your weekly investments helps too. Once it's set up, investing becomes as routine as paying a bill. You don't have to think about it, and over time, those small steps add up to something significant. The beauty of starting early is that your money works for you, quietly compounding in the background. Even if you can only spare $25 a week, those contributions add up faster than you might expect. The most important thing is to take that first step and commit to the process, giving your investments the time they need to grow. So how do you turn this understanding of time into a habit you'll actually stick to? Let's explore. Building the habit of investing is the real engine behind long-term financial growth. It's not about making perfect stock picks or waiting for the economy to improve. It's about showing up week after week and sticking to your plan, even when life gets busy or progress feels slow. The truth is, most people don't fall short because of market swings or lack of knowledge. They struggle because staying consistent in the face of daily distractions and competing priorities is genuinely hard. That's why automation is such a powerful tool. Automate weekly transfers. Set it and forget it like a recurring bill. This removes decision fatigue and keeps you on track. Studies show automated contributions cut missed payments by over 50%, so you're far less likely to skip a week. Once your system is in place, investing becomes as routine as paying for your phone plan or streaming service. You don't have to rely on willpower or try to remember each week. It just happens in the background, quietly building your future. Of course, even with automation, there are moments when progress feels slow. After months of regular $100 deposits, your portfolio might seem underwhelming. It's easy to wonder if it's really making a difference when the numbers grow by just a few dollars each week. This is where mindset matters most. Instead of focusing on instant results, remember that every single deposit is like adding another brick to your financial foundation. Early on, the change is barely visible, but over time, those bricks start to stack up. As compounding takes over, small gains begin to accelerate, and the growth you once barely noticed suddenly becomes significant. Think of it like building fitness. If you only watch the scale, you'll get discouraged by slow changes. But if you focus on showing up, taking a walk, hitting the gym, making healthy choices, those small, steady actions build real progress over time. Investing is no different. It's not about obsessing over your portfolio every month. It's about the discipline of showing up and letting the process work. Temptation is another hurdle. When money feels tight or something fun comes up, a dinner out, new shoes, a spontaneous weekend trip, it's easy to justify skipping your investment for the week. But by reframing that $100 as a gift to your future self, you make investing feel less like a sacrifice and more like progress. Each contribution isn't just money set aside, It's a step toward financial security, freedom, and the ability to say yes to bigger opportunities down the road. Everyone slips up sometimes. Maybe you miss a week, or a month is tougher than usual. That doesn't erase your progress. What matters is returning to your habit. Consistency doesn't mean perfection. It means showing up more often than not, and getting back on track if you stumble. The momentum you build by investing regularly is far more important than any single missed deposit. Studies on habit formation consistently show that small, repeatable actions are far more effective than grand one-off efforts. Whether you start with $100, $50, or even $25 a week, what matters most is making investing a routine part of your life. Over time, these contributions add up, not just in your portfolio, but in your confidence and sense of control over your future. The reality is, the habit itself is the foundation for long-term wealth. By focusing on the process, automating your investments, maintaining perspective during slow periods, and viewing each deposit as progress, you set yourself up for results that go far beyond what any single week or month can show. Your financial growth becomes less about luck or timing and more about the steady, quiet work happening in the background. Ready to build this habit? Up next, the ultimate takeaway from a decade of small, consistent investments. Building wealth comes down to a few simple truths. Remember, consistency compounds, time multiplies, and your only regret is waiting. Putting aside $100, $50, or even $25 each week might feel small, but those regular actions add up faster than you think. The important part isn't the amount. It's making the commitment and letting time and discipline do the work. Start with whatever fits your budget today. The habit you build now will do more for your future than any attempt to time the market or chase quick wins. If you found this helpful, like the video and subscribe for more no-fluff investing strategies. What's one small amount you can commit to this week? Let us know in the comments.